Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest and one of my good friends for over a decade now. We've been in the newsletter business and covering gold stocks for a very, very long time. He just put out a new book. This is actually the first interview he's done on his new book. We're recording this interview on Tuesday, January 28th, 2025. The US dollar gold price has rallied substantially. It was range bound for a while, despite a relatively strong dollar and long duration government bonds, the yield starting to spike. The gold price is at $2,761, almost $2,800, shockingly. His new book, which our listeners, I believe, is for free. They can go and download it at thedailygold.com/book. Gold and silver, the greatest bull market has begun. Jordan Roy Byrne, thank you for joining me again.
Hey, Jason, thanks so much for having me.
Yes, and I'm really honored that this is the first interview for your new book, and thank you for sending it to me ahead of time. I want to get your thoughts on the gold market right now with the US dollar gold price. I know you look at past cycles, past financial history with charts and the way the gold price behaves. Are you surprised that the gold price was range bound, was holding up above 2,600? It seemed every time it dropped below 2,600, it would rally substantially over the last 6 to 9 months. Are you surprised that the US dollar gold price has held up well despite a relatively strong dollar relative to the other currencies and the bond yields on US Treasuries and others starting to rise?
Yes, I'm a little surprised. Gold, as we know, it had this epic breakout from a 13-year cup and handle pattern, ran up to 2,800 in about 6 months or so after the breakout. And if it would have gone a little farther, I would have expected a bigger correction. I mean, I think it corrected about 9%, but when it put in the low in the middle of November, I think it came down just below 2550. The 200-day moving average was still at the time, I think it was like in the low 2400s. Today it's at 2535. And the reason that's important is because the other times, if I remember correctly, the other times historically that gold broke out to a new all-time high and then it made a big move, it came back, and I think two times it tested the 200-day moving average, and then one time it tested the 150-day moving average. So that is kind of a template that I'm working with as far as the correction. Now here and now, the 200 days at 25.35. Of course, gold's at 27.67 now. So I am a little surprised. I would be surprised if it were to rise to 3,000 or 3,100 here before testing the 200-day. I think the bear market in bonds, which is a big part of the book, which bonds began a secular bear market after or in the middle of COVID when interest rates bottomed, and the secular indicator I use for that is the inflation adjusted total real return of long term bond prices. So when it goes below the 80-month moving average, that's the signal that you're in a new secular bear for bonds. So that's also a big part of what's going on, what has been going on for gold in the last couple of years, because you do have money that's coming out of bonds, and most of that money is going into stocks like the Mag 7. But some of that money, again, not most, but some of that at this point, or I shouldn't say at this point, in the last few years has been going into gold. So that has helped gold, and that is still there. So yeah, I'm a little surprised. I mean, bigger picture, the surprising thing is that, we have this move in gold and, to a lesser degree in silver and the miners, but gold is not outperforming the stock market. Like, you're still in a secular bull for the stock market. I know we can get more into that, now or later in the interview if you want, but that's really the difference between now and the other times in history. Every time gold has made a huge breakout, there's been about 7 of them historically. It's obviously outperformed the stock market during those points in time. Now, it has not been outperforming the stock market. So now there is some similarity to the mid 1960s, where of course, gold didn't trade, but gold stocks were really, or they functioned as gold at that time, and they had an epic breakout in 1964. Of course, the secular bull in U.S. stocks didn't end until the end of 68. I mean, the Dow peaked in 66, but the S&P didn't peak until the end of 68. The secular bear in bonds, that began in 1965. So there are a lot of similarities to now in the mid 1960s. But even in the mid 1960s, you had energy stocks and gold stocks, especially. They were really strongly outperforming the stock market. The stock market's gains slowed down after the early 60s, but it's still, was still able to trend higher a little bit and maintain the 40-month moving average again until the end of 1968. So bigger picture, that's just what the conundrum for me is: when are we going to see gold really overtake the stock market? And when is this secular bull in U.S. stocks, which has been ongoing since 2009? When is that going to end? Because when that happens, that will be the trigger for gold going way, way higher, which a lot of people have been predicting, but including myself, but too early.
Well, I think you touched on some macro cross currents, and it's very confusing out there because you have some risk off behavior where capital is flowing into gold, capital, especially in other currencies, because I think the Japanese yen gold price is at all-time highs. So especially in other currencies, the gold price has done well, even better than the US dollar gold price. But then you also have risk on behavior. You talked about the stock market, the US stock market indexes. I think there's a lot of flight capital from other countries, from emerging markets, from Europe, from China, that has ended up in S&P 500, Mag 7, Nvidia. It's even gone into these meme coin cryptos and some of these other meme stocks. I mean, it's just, or quantum computing, anything with quantum in its name, just absolutely ridiculous. So that's like what risk on behavior. So you have these cross currents of risk off and then risk on. So I think that potentially a lot of those that capital could have went into gold stocks and it's going elsewhere chasing potentially higher short-term returns.
Yeah, and I think talking about the leverage plays on gold, you have gold and then you have gold stocks, silver, juniors, exploration juniors, all of those as a group. A big reason why they've underperformed is because, as you said, too much money, and as I've been saying, too much money is buying conventional stocks, or it's buying the stock ETFs in the U.S. It's going into the Mag 7. Some of that is going into this crypto nonsense, which reminds me about the yeah. I mean, you got fart coin, and there's even a butthole coin. I think there's a cum rocket coin.
Trump, Melania. They're gonna start releasing, like, they'll have like all the meme coins for all the Trump family pumping up.
Yeah, I mean, this just reminds me of the dot-com stocks in 1999, 2000. But I mean, at least, even though those companies really had no value, at least there were a business, predicated on some actual business, even though they were, bad ideas and the cycle was ending. These meme coins, they're not worth anything. Like, they're completely worthless. Like, this is just rank gambling and speculation. And yeah, so when the secular bull ends in the S&P, which probably should coincide with the next downturn in the economy, I mean, that's a big question. When that happens, I think we're going to see a massive amount of capital just move out of conventional assets. And I guess in Bitcoin, if you look, not to go off on a tangent, but Bitcoin is it's not a currency or crypto. I mean, it's all of it. It's especially Bitcoin. It's traded like a tech stock, basically. I mean, if you look at how it's traded, it's mirrored that of the Nasdaq, since 2009, 2010. So it's a competitor to gold in the same way that stocks are a competitor to gold. So that, again, when the secular bull ends in the S&P, this crypto, all of this is going to go to zero, probably, except, Bitcoin, maybe Ethereum. But look, if Bitcoin does have a future in the next 10 or 20 years, it could still go down 95% when we get the bust. I mean, look what happened to Amazon. So I don't know what the future is, but I mean, you and I have been around long enough to know that, a nasty crash is coming for crypto at some point. And yeah, I mean, it's just part of, yeah, it's also a sign that, we're coming to the end of this secular bull market in U.S. stocks.
There was a recent piece out, I don't know if you saw it, I think it was Business Insider, and I was talking about how basically the American economy and a lot of our capital markets have become like basically all a casino with the levels of gambling and short-term gambling and sports betting and betting on elections. So that just seems based on like the Instagram culture. There's a lot of young adults, men and women now. I mean, I've just met young women now that are talking about like all their sports betting now, betting on their phones and gambling on crypto. So like the culture now is you only live once, YOLO, and FOMO, fear of missing out. And people are not looking at like necessarily dividend stocks or diversifying. They're trying to get rich quick on some type of gambling scheme.
Yeah, and I mean it's also I don't know who wrote it, but someone wrote something on a Substack I think a year or so ago about how that's also a symptom of inflation, like really persistent inflation, like over time. You know, you get a lot of gambling, and you know, this is the stuff you kind of see at the end of secular bull markets in stocks. And as I said, we're going into one, and um, gold and secondarily silver, they benefit when the secular trend in stocks ends. So on the other side of all this speculation and gambling will be, a huge bull market in precious metals, and it's something I pointed out in the book. I mean, people will look at this and they'll say, oh, well, gold, I mean, it's expensive now. It's at an all-time high. I mean, it's gone up since 2016. But if you really look at gold and silver, you measure them against the monetary base or the S&P 500 or, some other things I mentioned in the book. They've really not. They're still cheap against these metrics, like my gold and silver against the 60/40 portfolio, which is one indicator I'm very proud of. And by the way, if you look at gold against the 60/40 portfolio, I recently updated that. That's really close to breaking out. So that's one of my key indicators. Although we need to see gold break out against the S&P, it needs to move above 0.50 to really confirm a breakout for the whole thing. Silver against the 60/40, I think in the last few years, like it's just coming off a double bottom. The other bottom, I think, was in 2000. So, when you really look at historical data and 100-year data and charts and these types of things and compare gold and silver to all these things, not just nominal prices, they really help me make the argument that we are coming out of a secular bear. Like we're really early in a new secular bull, and there's a really long way to go. Like this is going to run well into the 2030s. Like this is not just going to be like a 2 or 3 year blow off like some people are thinking. Like this has barely even started yet.
Now, I want to ask you about gold stocks. So the way you measure the gold stock ETF is GDX. That's the most common one, the most liquid that a lot of hedge funds and institutional investors trade. It's drastically underperformed the gold price. Let me just pull up what it says where the GDX is right now. So the GDX is at, okay, we're at 3770 for the GDX when we're recording this interview. Now, I think the all-time high for the GDX was like 65 or 68, something in that range in 2011. That's when the gold price was around $2,000 an ounce. Why do you think the gold stocks have drastically underperformed so much the gold price? And what the underperformance is over 30%. It's like 40 or 50%. It's really high.
Yeah, there's a couple reasons. First of all, this is another indicator I'm proud of. If you look at the inflation adjusted gold price and you look at that chart and you compare it with the Barron's Gold Mining Index, which I have data going back to 1938 and then an index attached to it from Nick Laird at Gold Charts R Us. So if you look at gold stocks and you compare it to the inflation adjusted gold price, they actually look really, really close. And I remember thinking like 5 years ago, like, gold against the CPI, who cares about that? Like, why is this doesn't mean anything. But, I don't know where I got the idea. But, I looked at the two together and I'm like, this makes perfect sense. And the reason is because gold stocks, they don't necessarily follow the gold price. They follow the gold price minus costs. And so if we use inflation as a proxy for costs, it works out really well. And I used to think that, and some people have said you can use gold against the CPI, gold against commodity prices as an indicator for gold stock, profits or their mining margins. But it doesn't quite work as well as gold against the CPI. So if you look at gold against the CPI, and you look at the last 100 years. I mean, I do have a couple charts in the book. Like you can see, wow, these look really really similar. And so it again, gold stocks follow gold less costs, and so the CPI can be a great indicator for cost. So hence, gold stocks really follow the inflation adjusted gold price. Over long period of time. They're not necessarily going to follow it every month or every quarter, but and so if you look at that, gold stocks are actually, so if we're looking at GDX now, so 37, the highs, around 60. So gold stocks are, they would have to go up like, I don't know, 50 or 55% to get to the all-time high. If you look at their valuations, historically, gold stocks have traded, going back to the 70s, they have tended to trade from about 6 times cash flow up to 25 times cash flow. So a couple times it has gotten into the 20s. And right now they're trading at 8 times cash flow. So if they were trading at 12 times cash flow, just like an average valuation, they would be pretty close to their all-time high and basically like almost perfectly in line with the inflation adjusted gold price. So that's a really long answer for and there's a couple of things I want to add, but that's a long answer for the first reason, which is they follow the margins and not necessarily gold price. The other two reasons are basically we're in a secular bear market. So we've been in a secular bear market from 2011 until you can say the end of 23 or early 24 or October 23. So we were in the secular bear market. And so naturally valuations are going to come down. They're going to be lower in a secular bear market. The other reason is the advent of all these ETFs in the mid 2000s. Like I think and I'm speaking about the advent of gold and silver ETFs. So GLD, the first ETF, I think that didn't come about until the end of 2004. That didn't begin to be popularized for a couple years. And so up until that point, Jason, there was no real way to buy gold. Like you would have to go to a futures broker. You'd have to go to a coin shop. Like there was no way someone just managing their money could invest in gold or even, anything similar to gold. Like you couldn't buy tips, you couldn't buy emerging markets. So basically gold stocks were, they were one of the best and one of the only options. If you were kind of negative about the economy or you're worried about inflation, you would invest in gold stocks. So gold stocks basically functioned as gold for all investors until 2004, 2005, 2006-ish. So that's a big reason. There's a lot more competition for gold stocks. So I think I know that you're very keen on the missteps of these major miners, but I think there being a secular bear market and also now that they face so much more competition, first and foremost from the gold ETFs, like that's a big reason why they have really fell out of favor completely. And, if we think about what's going on now, generalists, like they don't want to touch gold stocks because of a lot of the missteps that about. They look at long-term charts and they say, oh, well, they're not going to outperform, they're not going to outperform gold. So I'm just going to buy gold. So that's what's going on now. You have a lot of generalists who are, they're buying the Mag 7, but they're also dipping into gold, but not the gold stocks. And so because of what's going on with the ETFs or what happened, where now people can easily buy gold and silver, they don't need to buy gold stocks. And so that has basically reduced gold stocks to options. Like they're basically options on gold. And silver is really the same. Like they're both just options on gold. So they will perform the best when you get a strong trending move in gold, or when gold is coming off of a really hard correction. It has like a rally off of V bottom. So those those are all the reasons. Last thing I do want to mention is if you look at the inflation adjusted gold price, it is really close to breaking out of a 45-year base. So I do tend to think, if I'm right in this next leg in gold, we get a big move to like 4 or 5,000 in the next few years. I do think you will see gold stocks like really start to outperform at that point in time because, again, if you look at the inflation adjusted gold price chart, a 45-year breakout is really, really significant. So we could be on the cusp of, the next big leg in gold. It could make that move. I mean, before you really see inflation reaccelerate.
You definitely brought up with the first point there about profit margins for the gold miners. I think that's a very important point because if we go back and we look at, it's easiest to do with Newmont Mining or Barrick Gold. I think in 2020, 2021, that was kind of the lowest point where the miners actually had a benefit of lower energy prices, lower labor costs. The gold price was just starting to perk up a little bit before it went into correction mode. They had record profit margins. That was one of the first times in many, many years where the costs actually fell for the miners. Overall, though, like I think since from 2020 up until now in early 2025, I mean, like Barrick Gold and Newmont Mining, the costs were a little above $1,000 an ounce all-in sustaining costs, and here we are now. Their costs are closer to $1,600 an ounce all-in sustaining costs. Overall, the industry, Jordan, the costs are up a lot over the last 4 or 5 years. It's up like from $1,100-$1,200 an ounce up to, I think the industry average is considered around $1,500 an ounce, and it's still trending higher due to issues with ore grades and other things. So, those profit margins, the free cash flow, the generalist investor, like you said, they're looking at this and they're seeing, well, Barrick Gold, Newmont Mining, those are the two main ones that a large hedge fund or a generalist investor would want to buy first if they don't buy the GDX. And they're going to say, well, Barrick Gold and Newmont Mining, they either have problems at one of the mines or they never beat on costs, and the earnings and revenue numbers, their free cash flow is never what the market is expecting. So they don't beat the numbers like NVIDIA or one of these other tech stocks. They routinely underperform their quarterly earnings guidance.
Yeah, and I'm not a fan of big miners. If you look at, I mean, I gave some examples in the book. Like you're not, if you look at how much like GDXJ, if you compare GDXJ to GDX, yes, GDXJ does have some really large juniors in it. It's not really a junior index anymore. But that being said, if you look at the moves in GDX and the HUI, especially in the last 10, 15, 20 years or so, you don't like bigger stocks, like bigger mining stocks don't protect you on the downside. Like you think, oh, I'm just gonna buy Newmont and Barrick. It's going to be safe. Like you're much
look at a max chart. Yeah.
Yeah, you're much better off. Like in that scenario, like you're much better off probably just buying gold or Franco Nevada or Wheaton Precious or something like that. Like you're not. And then on the upside, like they underperform. Like I gave some examples in the book, like from 04 to 07, from the end of 08 to 2011, GDXJ performed way better than GDX. So you don't gain any safety by investing in the biggest companies. And one junior CEO told me this, like mining is a Ponzi scheme to some degree because you're consuming the product that you produce. And so it's just, these are not, these companies, like, I don't know how many mines these companies have, like, Barrick and Newmont. And of course, Newmont's selling their mines now. And it's funny because juniors are buying their mines, which are decent, and they're actually going up after these acquisitions. The share prices are going up, but that's another story. But yeah, it's just a really hard you have all these mines in different parts of the world. I mean, there's political risk, currency risk, as you pointed out, the costs, they never come down. They're always going up to some degree. It's just, look, this business is a Ponzi scheme, and it's just best to, and again, you look at the performance, how a lot of these companies perform. Like, to me, I think you're going to be better off. And Rick Rule would say this too. Like, you really have to do your homework. Like, you can't just randomly say, oh, I'm just going to buy like 10 random juniors. If you really do your homework and try and, pick a portfolio of 5 really good companies or 10 really good companies, you are going to outperform GDX and GDXJ over time. I mean,
And
if
Barrick or
you,
Newmont, because I mean,
yeah,
like you said, them Barrick and Newmont are each producing around 5 million ounces, 5 million ounces a year of gold. I mean, that's very inefficient. The grades are a problem, the costs are a problem. Barrick, I think, like they're potentially going to have a mine seized of producing one in Mali. So the government's either trying to renegotiate the royalty tax, or they've been talking about seizing the mine, and that caused the stock a huge drop in the stock over the last like 4 or 5 months.
yeah, and it's not going to make it back up. Like I mean, it will eventually, but it's not something that can recover quickly. Yeah, and I mean, if you're, that kind of business, if you're producing 5 million ounces a year, I mean, that's like impossible just to grow your production like 20% or 10%. And if you got inflation, if your costs are going up 7 or 10% a year, even though the CPI is only going up 3% a year, it's just an impossible business to run. And I mean, this is not like the 70s, 80s, and 90s when, people still bought these companies because that's the only way they could buy gold, and so these companies traded at much higher valuations than they do today. So yeah, I would avoid the big companies unless you really, really know what you're doing and research and become an expert on these companies. It's a difficult business. You can't just assume it's, you're like buying Facebook or, a big oil company.
Now, in our prior interviews over the last like year and a half, you've talked about how you expect the gold price to, once it gets to $3,000 an ounce after being in a consolidation and basing mode for a year or so, maybe a little bit longer than that, to eventually break out. What would we need to see for the gold price to have a sustainable breakout above $3,000 an ounce and maybe head to 3,500 or higher?
Yeah, that's a really good question. Because I've been wrong about this. Like I remember saying 2 or 3 years ago, like, oh, we need the stock market to crack for gold to go above 2,100. Like there's no way, there's no way it can move while the stock market's going up. Um, so yeah, I'm a little, not a little, but I'd be really surprised if gold got well above 3,000 without some turbulence in the stock market. I mean, you basically would need fundamentally, I think, if we're talking about 3,500, beyond just 31 or 32, you basically need a problem in the market or the economy that forces the Fed to reaccelerate their cutting of rates. I think that's like macro wise, and I'm not an economist or anything like that. So predictions can be dubious, but I think maybe we could kind of have one more pop in inflation, and perhaps that causes a recession. Because if you look at recessions, I did a video about this. Everybody knows about this inverted yield curve, and then the steepening of the yield curve is a great recession signal. Well, if you look at every recession, basically, there's always been a move in commodity prices that tips the economy into recession. If you look at commodity prices now, they're starting to perk up. Oil is still below. I mean, it's really been the laggard amongst commodity prices. But if we do see kind of a pop in commodity prices and, inflation gets up to, 4% this year, I think that, that could potentially tip the economy into recession. And then you get really, aggressive rate cuts at that point. I think that would, when you have the stock market going down, going into a real bear market, Fed having to cut aggressively, that to me is what gets gold to 3,500, 4,000. I mean, one technical comment, all the cup and handles that I studied, and there's none that are as clean and perfect as gold's cup and handle. They went from the initial target, the measured upside target, to the log target, which is basically the percentage target. They went from target 1 to target 2, the log target, in 6 to 12 months. All of them did. So based on that, when gold hits 3,000, based on that, then it could hit 4,000 in 6 to 12 months. So we'll see if that still plays out. But again, gold outperforming the stock market. This is just so huge. Like this is the key to almost everything. Because if we think about, we talked about this earlier, Jason, where's the money going? There's a secular bear now in bonds. So these pension funds, these old people with money, sovereign wealth funds, all these organizations that or whatever you want to call them, who they manage like big money, hundreds of millions of dollars in some cases. And they love buying bonds, years and years ago, because you can make 2 or 3% or 4%. That's a shitload of income on like 100 million or like 300 or 400 million. Even if some old retiree has 10 million, they're getting tons of income just on 3 or 4%. But now that's over. So all these people, what are they doing now? Well, they're going into the stock market and the Mag 7. And also, if they're smart, they're going into the dividend aristocrats and they're getting their income that way. But and some of them are going into gold, to some degree. But what happens when gold outperforms the stock market and overtakes it? Then you're going to have people actually moving some of their money out of stocks and into gold. I mean, holy shit. Again, when you see that, that's going to trigger a huge move, and like a vertical move to 4 or 5,000.
So now I want to ask you about junior mining stocks, which you cover in your newsletter over the years. Are juniors at the current gold price, are they actually able to get funding? Are they doing their drill programs, or is capital still very scarce?
Yeah, it really depends on which juniors you're talking about. I mean, if we're talking about exploration juniors that are below a 50 million market cap, I would say if they don't have that great of prospects, that it is difficult. I mean, the market isn't really there. I mean, so some companies, some decent companies that are even private, are electing to stay private. So I would say, I mean, if the question is about, if we're terming junior, because I talk about this in the book, like there's different people, different people have a different definition of juniors. Like, you know, if you're talking to someone who's in Canada or Australia who's in the business, when you say juniors, like they're thinking of, almost like penny stocks or exploration stocks. But if you're talking to someone in the US who's more of a generalist, they think of the companies that are in GDXJ, which are not even juniors. These companies have market caps of $1 billion. Like that doesn't sound junior to me. But I mean, to answer your question, if we are talking about the smaller juniors, the exploration type of juniors who do have a market cap, below 50 million or 80 million, I mean, I've focused less on those in recent years than I did before, but I would say no. It's the market has not turned for them yet. But for the bigger companies that maybe they have a mine in production, they're making money, they really have good prospects. The bigger juniors, that is, they have good prospects to add value. They are able to fund no problem.
Yeah, I've actually been watching some of the producing miners, so the larger senior gold producers and the mid-tier ones, seeing what they reinvest into if they're funding juniors. The juniors are not, they're able to raise small amounts of money for drill programs, but a lot of them are not at the stage where they can go and build like marginal mines yet on their own. So they're looking for joint venture partners. You are seeing a lot of the larger companies that have better profit margins. So like either a royalty and streaming company, they're going and doing, I think Franco-Nevada and Osisko Gold Royalty just announced over $500 million towards a potential large copper and gold mine in Ecuador. So they are funding these types of deals. You're seeing some of the mid-tier gold miners go and reinvest into a junior or reinvest into their own projects. I think that's where the free cash flow is going first.
Yeah, absolutely. Yeah, and I'm focused on those, or I should say, yeah, not to deviate, but yeah, I am more focused on producers than explorers at this point. I think eventually, like when we see gold break out against the 60/40 and gold break out against the stock market, that's the time when you will start to see more money come into these smaller companies that have more marginal projects, or these small exploration companies that maybe they do deserve to get a couple million, but they're having a great difficulty trying to raise it. So all those things will start to happen when gold breaks out against my 60/40 ratio, and also when it breaks out against the stock market. Gold to the S&P, it's got to break above 0.50 convincingly.
So in your book in chapter 6, you talk about de-dollarization. What do you think are the odds that de-dollarization occurs quickly, or do you think that the gold price will rise no matter if there is no rapid de-dollarization?
Yeah, I think the price will rise if there, regardless of whether there's de-dollarization or not, or if it, if it occurs slowly rather than more quickly. Um, yeah, chapter 6 is a long chapter. I did have my buddy Vince Lancy. I don't know if you interviewed him, but you should at some point if you haven't. He wrote the half chapter on de-dollarization. So I will defer to him because it's not a subject I am well informed on, compared to people like Vince. But I will say there is a chart. I think it's in the first chapter, somewhere in the first chapter, where I do like this chart a lot. It shows, I think, the the reserves in gold. It has something to do with foreign central banks and how much of their reserves are in gold, and we can see how much lower that is compared to like 1970. But that has been picking up in recent years. So I think that that explains that there's a lot more room for more central bank buying, but also more selling of treasuries and dollar assets and moving into gold. So there's a lot of room for that to occur. I don't know if that's too much of a tangent away from dollarization, but or de-dollarization. But that's when I think about de-dollarization, that's kind of how I think about it. The mechanics of all these companies setting up their there's a new payment system that the BRICS are going to be using. I mean, a lot those things are over my head. I think some people kind of sensationalize it. But yeah, if it doesn't happen, either way, we need gold to outperform the S&P 500. Like that's a much bigger development or indicator at this point. But I mean, de-dollarization and global central banks moving away from dollar assets, that is real, and that has helped gold in recent years. Even though the stock market keeps rising.
Oh, yeah, I totally agree that the non G7 central banks, really since the Russia sanctions in early 2022, they've been dollar cost averaging. So their reserves, their foreign exchange reserves, trade surpluses, they've doubled basically the monthly purchases of gold tonnage, the non G7 central banks, compared to prior to the Russia sanctions in 2022. So we've had a doubling each month of monthly gold purchases, gold tonnage, compared to before the Russia sanctions. And that seems to be what the new base case in the market. The marginal demand, Jordan, has really come. It hasn't been for gold stocks, but it's been for physical gold and silver, and it's been from the retail investors and like pension funds and institutional investors out of Asian countries. So like China, non-central bank demand. So the real surprise demand increases have been like from retail investors in like Japan, China, India, Korea, Taiwan, Vietnam, those types of countries. We've seen just a huge increase in overall demand the last 12 to 18 months.
Yeah, and so I think really that kind of buying, along with bonds going into a secular bear, those are the two things that helped gold, especially I would say at the end of the handle consolidation on the cup and handle pattern. I mean, the Fed's starting to cut rates again. That helped a lot this year, but those two things I think prevented gold from going lower than it did, and again keeping it in a very bullish formation, inside of that cup and handle pattern. In the last half of the that handle part.
So as excuse me, so as we wrap up here, do you think then that gold can continue to consolidate here, or do you think that if even if the dollar rallies, even if Trump manages to balance the budget, or the Department of Government Efficiency manages to cut costs, the budget deficits come in, maybe with the supply side economics that Trump's going to run, the tax receipts grow overall, even though the total tax percentage that Americans are paying is going down with the tax cuts, but overall receipts increase due to economic activity. Do you think that those factors will not prevent the gold price from falling, or do you think that gold's going to stay in a consolidation mode in the near term?
Yeah, I mean, just looking at the chart now, I would think gold will stay, if it doesn't break out, here in the very short term. I would say it would probably trade in a bullish consolidation. Um, yeah, that's That's really how I look at it. I mean, if it keeps consolidating and it pulls back, it could be setting up a potential ascending triangle pattern. We're looking at that. It could have a measured upside target of 3,100. So I think that's kind of how I'm looking at this year. I mean, as far as the new policies that are coming in, I mean, it's hard to say. I mean, I think the realistic worst thing for gold would be like a continuation of what's going on now, where they can just keep the economy going. It's kind of running, it's not strong, but it's running a little hot. You do have big deficits, but you have high nominal growth with some inflation, and that's not enough to get people buying stocks to get some of them buying gold. That to me is the realistic risk for gold over the next year or so. And look, the worst thing for gold, you have all these people predicting crashes and all of that. The worst thing for gold is when you have a strong economy that forces real interest rates higher. And so if you have strong economic growth and strong real interest rates, that's the worst thing for gold. I mean, we had that in the early 80s. We had that I think after 2011, you had a big increase in real interest rates. So that to me, and we did have that after COVID. I mean, it was an artificial boom because of all the money, but we kind of had that 2021 into 2022, and of course, gold, it peaked in the summer of 2020. So that to me is, economic strength. That to me is the real risk for gold. I mean, can the policymakers bring that out? Like, I'm not so sure. I mean, we didn't talk much about the budget deficit and the interest on the debt. I mean, that's a huge problem. I think Treasury Secretary Bessent knows that they're going to have to do yield curve control at some point, and potentially monetize the debt. I mean, I think that's almost inevitable. So I don't know how they can forestall that. I think they do want to run the economy really hot, and try and, manage inflation as best they can. But, yeah, I mean, so that kind of scenario,
He
which I
inherited
already
a mess.
mentioned.
I mean, at this point, if you just want to talk the basic math, Jordan, I mean, Trump inherited a mess. It was a mess before Biden got there. It just seems like it gets worse every couple of years. I mean, if you want to just talk the sobering math, I think $8 trillion was spent in the last like 12 months for US federal government spending $8 trillion. And so the budget deficits were actually, the CBO's wrong. They always lie. The Congressional Budget Office always underestimates and lies. They said that the total national debt wouldn't get to 40 trillion, I think, until like 2030 or some ridiculous. And here we are. We'll be there in like every like 90 or 100 days. We're adding another trillion. But
Yeah, yeah, you mentioned it. It's really it's an impossible situation that they're coming into, but I do want to make the point, like a bear market in a recession is not bearish for gold. Like, everybody just assumes that it's bearish. And my view is, yeah, I mean, if you get that at some point, gold could correct 10 or maybe 15%, but this is completely different than 2008. Like, people are so locked into 2008, they forget what happened from 2001 and 2002. You had a bear market, gold stocks went up, gold went up too. They forget what happened in the 70s, where from 73 to 78, basically, you had an inverse correlation between precious metals and the stock market. When precious metals went up, and they were rising, we were having major problems, and and vice versa. When gold had its 45% correction from 75 to 76, that's when the economy recovered, at least briefly. The economy and the market recovered. So I think, and you'll see this in the book, like, I think we are going to see some of that in the next 10 years, where there is going to be an inverse correlation. And so I think if we do get, or whenever we get the next downturn, I really think you'll see precious metals, they're going to diverge and move higher during the downturn. Now, look, that doesn't mean they're going to move higher every single week and every single month. Looking at gold stocks from '01 to '02 and from 73 to 74, yeah, they were going up when the market was going down, but they still had, a 25% correction here, 22% here. So, but that's just my larger point because there's so many people out there who are saying, "Oh, just wait, don't buy precious metals. Just wait for the crash. Wait for the big downturn." And like I vehemently disagree with that. Like you're not going to see a crash in precious. The crashes come in the middle of the secular bear markets. 75 to 76, that was the middle. 2008, that was in the middle. So we are going to have a huge boom first in precious metals before we have that crash. Like it's 4 or 5 years away probably. So I just and look, I'm not saying buy everything today or go completely all in now, but I'm just pointing out, look, everything plays out differently, but this is not going to be a repeat of '08. Like the amount of money that was in precious metals in 2008 is nothing compared to the amount. There's very few people that are going to sell when we have a downturn. It's going to be the opposite this time. So I wanted to just make that point before we closed.
Yeah, I don't think we're going to have 3 trillion a year budget deficits necessarily with Trump. We'll have to see. It looks like there is going to be some cost savings with the Department of Government Efficiency. I'm cautiously optimistic that they will cut some spending, but we were running around 3 trillion a year budget deficits the last year or two of Biden. That's how bad things were. They were spending 8 trillion a year. I mean, the amount of waste, fraud, corruption, and abuse was absolutely shocking. Add on to that, like you said, the $1 trillion plus per year interest payments on the national debt. You have bond yields creeping back up. These things historically, Jordan, are inflationary. I mean, it's stagflation, so not hyperinflation. I know like the gold and silver community love to talk about hyperinflation, but if we have stagflation, I think that'll also be good for the gold and silver price because you're going to have slow and steady increases in the gold price. What gold stocks, though, do you think could actually, do you think are cheap now? Do you think are good risk adjusted returns? Do you like a low cost senior producer like an Agnico Eagle with 2 low-cost producing mines in Canada? Do you like the royalty and streaming companies? Are there ones people should avoid?
Yeah, I would say, well, right now, until we get gold breaking out against the stock market and gold breaking out against the 60/40 portfolio, until that happens, you really have to focus on quality and what companies are. They're cheap based on the current price. So when I'm evaluating things, I look at, I forget what I use for silver, but for gold, I'm looking at 2,500 or 2,600. Like when you're evaluating things, use the current price because if you're so focused on okay, gold's going to go to 4,000 or silver is going to go to 50, I need to buy. I need to evaluate everything based on that. Like, don't do it that way. Do it by looking at the company itself and ask yourself, can this thing add more value at the current metals prices? Because if it's cheap at the current metals prices, then it's definitely cheap at the higher, at higher levels. And so, I tend to be focused on, junior producers and also developers that are building mines. I did mention in the book, I did put this in. I don't know if you saw the updated copy I gave you, but I did. I know you've interviewed Lobo Tigre, and I do like the strategy of buying before or when companies are building mines because that's when you get the biggest re-rating when a company successfully builds a mine or
That's the
when they're growing
Lassonde
their
curve.
production.
That's like
When they're because if you look at the Lassonde curve, like there's basically that's the best buy point. Right at the bottom there. Right when a company begins construction, or maybe a little bit before then, or when it's in the middle of construction. That's usually the best buying opportunity. The other one is before a company makes a big discovery or before they max out their exploration. So the problem with that is it's just there's so many of these companies out there that they've really maxed out their exploration potential, but they're still raising money to do exploration. They have an okay project, and they're just kind of stuck. They're just they'll go up if gold can break out again, but otherwise they're not going to do much. So it's so much harder. It's so much harder to evaluate the explorers and who have that biggest wave coming of growing their deposit, making a discovery versus companies that are building their mines. So for me, that's why I focus on production growth and companies that are building mines.
So you're talking about the optionality for the juniors and how risky it is because a lot of people don't have a geology background, so they can't tell how the good the drill holes. And we know like there's tons of articles out there about how like drill holes can be falsified and misled with those press releases just to raise money or so the insiders can dump the shares, and then they do the reverse stock split. Unfortunately, you and me have been in this over 15 years now, or around 15 years, dealing with a lot of these juniors that have done this. I think the optionality here, and it's kind of hidden in a lot of these precious metal royalty and streaming companies, especially like the larger ones, the mid-tier ones, they have these royalties that they bought for a couple $1 million. If the junior does start to raise money for a drilling program and they do find a mine, I mean, these are like free call options, optionality that are hidden free assets, basically, that were very, very cheap out of the money call options that don't expire, I would say, that were hidden in the portfolio for a lot of these royalty and streaming companies. And I think some of them will hit if the gold price does go to 3,500, 4,000. Some of these juniors will raise more capital. They will build mines. I can't tell you which ones. And, you're getting paid to wait in a company like Franco-Nevada or some of the mid-tier precious metal royalty and streaming companies. I just don't hear a lot of the other gold stock analysts talk about the optionality of the cheap royalties that a lot of these companies own.
Yeah, and I mean that's like that's optionality on company or on projects and or I should say projects on or mines that have a better chance of being built than versus optionality on, oh, this company has 5 million ounces here, and this has to go up eventually. So you want to focus, what you're talking about, that's good because you're going to benefit from a mine and a project being built, and then you can look at those and figure out which ones really have a chance to be built.
Well,
Versus
you're buying a business
and
that already has free cash flow. So you're buying like Franco-Nevada still has good profit margins at the current gold price, right? So yeah, they have their one Cobre Panama mistake. The bad news is probably already priced in. They still have good free cash flow and good profit margins. You don't have to worry about the same problems with Barrick Gold and Newmont with the cost rising, though.
yes.
And then you have the discovery. So I think like if you're right and the gold price does go to 3,000, 3,500, I mean, some of these juniors will finally be able to raise some capital, and then the drilling will start to increase again, and there will be more discoveries. We're just not seeing a lot of that right now, except for a few select discoveries here or there.
Yeah, even though metals prices have gone up, yeah, it's a tough market for exploration right now.
Well, I mean, the producers aren't, they're funding some joint venture drill programs with the juniors here or there, but most of the free cash flow is paying down debt, fixing the balance sheet, or they're using it as like brownfields exploration. So like you're seeing producing, I think like Agnico Eagle just did a small acquisition around like the land deposits around Canadian Malarctic. So that was probably a nice under the radar one. But most of the other producers like Alamos Gold, an SSR, some of the ones that are looking like a Kinross Gold that are looking interesting as a mid tier. I mean, most of their free cash flow is just going back into their existing mines.
Yeah, and that's another thing. Yeah, not to go off on a tangent, but I like with producers, look for the producers that, and even some developers too. Like look for the ones that are reinvesting their cash flow in exploration, because that's another that's a way that they can add value. If you're looking at a producer and yeah, most of them maybe they're just they're focused on building the mine and there's not really that much after that. But if you look at if you can find the ones that are reinvesting back into exploration or investing in exploration as they're building a mine, that's another way to invest in exploration. Like I call it the holy grail of junior mining. Like if a company's building a mine and then they make a major discovery or a significant discovery at the same time. So that's another way that if you like exploration, by the producers and the developers that are doing exploration, you can benefit from production and exploration.
Yeah, Lundin Gold's having a lot of success with that with their main mine. They only have one mine right now, but it's arguably the best one, Fruta del Norte in Ecuador. So they've just expanded the reserves enormously. I think they keep finding higher grade and expanding the resource. So that would be a good example of what you just said. As we wrap up here, Jordan, I want to thank you so much for your time. How do my listeners download your book or listen to it on audiobook?
They can go to thedailygold.com/book. I will be recording it on YouTube, going through lots of the images as well at some point in the very, very near future. But again, to get it right now, you get a PDF copy at thedailygold.com/book.
Again, and thank you so much for your time today. I really appreciate it, and I'm honored that you chose me to be your first interview for the book.
Well, my pleasure. I really enjoyed it. Thanks so much, Jason.